Hello, everyone. Today on the Final Bar, my guest is Jesse Felder, publisher of the Felder Report. I'm going to talk to us a little bit about asset allocation, how we need to think about the U.S. versus other markets. We're at this point where the S&P, again, approaching 3,400, again, teasing that level, but again, not able to close above it. So we continue to be stagnant right around these current levels, leaving many to think, is this a pause before the next upswing or the beginning of something deeper? Ladies and gentlemen, this is the Final Bar. Good afternoon, everyone. Happy, beautiful week here in Redmond, Washington. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday for the Final Bar as we break down the activities in the markets. Look at this S&P that continues to threaten 3,400, but once again, unable to close above that key level, but seeming to set the stage with plenty of stocks continuing to the upside of sort of the large cap growth that led today with communication services, consumer discretionary 1 and 2, when we're looking at the sectors, and the laggards are things like energy and financial, sort of the traditional laggards that we've seen. So it wasn't much of a rotation, is sort of a more of the same, but with not enough momentum, not enough upside push to get us through that next ceiling. It'll be interesting to look at some of the individual names that make up the market and look for what sort of themes we can identify. Also, we're going to do a mailbag segment a little bit later in the show today, answering some of your questions, some really, actually really thoughtful questions about some specific technical indicators, which we'll get to. A lot of fantastic guests on the show. I'm excited to have Jesse Felder back on the show today. Tomorrow on the 19th, we're going to have Katie Stockton from Fairlead Strategies. On Thursday, the 20th, Samantha Leduc from Leduc Trading. Coming up next week, we have Roman Bogomazov on the 25th. Roman's an expert in the Wyckoff method, which is a very well-articulated method of stock analysis. Doug Bush from ChartSmarter going to be joining us on August 26th, and then Tim Tashler on August 27th. So some really knowledgeable, thoughtful analysts and strategists joining us on the show in the coming weeks. Let's get to our market recap. I did want to start with a bit of an educational play here because I usually am asking survey questions on StockCharts TV and elsewhere about a market outlook, about what sectors you like. And I think the poll we just launched up there now is asking about paper, scissors, or rocks. Essentially, what do you see as the top performer going forward, gold, stocks, or bonds? And I'd encourage you to answer that in whatever venue you're listening to the program on. But recently we asked you about candle patterns and essentially said you have in an uptrend, you have a long up candle followed by a long solid candle or a long down candle. The second candle's body just goes over just halfway down through the first body. What candle pattern is this? 59% of you get an honorary, I was going to say an honorary CMT, but that's probably a little aggressive. You get a thumbs up from the Final Bar for correctly answering the dark cloud cover pattern. Essentially what that means is when you have a market in an uptrend, I, of course, should have been prepared to show you one of these, and I'm totally not. So I'm glancing very quickly at the IBB, which I just had one. Actually, I do happen to see one right here. So let's look at candle chart, and I'll show you exactly what I mean. A dark cloud cover is essentially when you have an upward trend, and I'm looking right about here. You have a long up candle, you have a solid dark candle, and the real body, which is the open to the close of day 2, goes at least 50% of the way through day 1. So this is right on the cusp of what you'd call a dark candle, a dark cloud cover, excuse me. This is different than a bearish engulfing pattern, which some of you answered. That's more like this one here at the top, where you had an up day and a down day, and the second day's candle completely engulfs the range of the first day. A bullish engulfing pattern would be like what you see here, a down candle followed by a big up candle. Hanging man, boy, I don't know if I'm going to be able to come up with one of those very quickly. A hanging man is actually one of these, where you see the in an uptrend, you see what looks like a hammer candle, but it's up at a top. That's actually called a hanging man. My point of asking that question is, number one, to confirm the fact that a dark cloud cover, which is the candle pattern that you see here, is short-term bearish. It tells you about the next couple bars, and what it tells you is we've had an uptrend, and then you'd expect the next couple bars to do weaker because the day two, the second bar, is going at least halfway through the first bar. So there's buying power in the first bar. There is selling pressure in the second bar, but the fact that the price has gone down and it's gone at least halfway through the first bar. So it's short-term negative, as is the bearish engulfing pattern. My other reason for asking this and why I'm bringing it up now is, to be honest with you, whether or not you remember that particular pattern is called the dark cloud cover or hanging man or bearish engulfing pattern means very little to me. If you're taking an exam, the CMT exam, you definitely should know that. It provides a way that you can discuss these sorts of patterns with other analysts, other traders. That's valuable too. But in terms of its ability to help you execute or be a better investor, I would argue that the titles are less important than thinking about the dynamics, what that means. This means day one is an up bar, day two is a down bar, and it goes at least halfway through. And that's really the main thing to pay attention to. Let's get to the rest of our market recap. So as I mentioned, the S&P again sort of teasing 3,400, but not able to get above it. If we look at the NASDAQ actually led the way higher, with the NASDAQ 100 up almost 1% over that time period. The VIX right just above 21, almost to 22. Looking at other markets very quickly, we had bonds going stronger today with the TLT up around 165. Looking at commodities, gold, silver continue to appreciate, following through from that pullback that we saw last week. And overall commodities as a group finishing a little more strongly. So here's the chart of the S&P 500, and again, we're right at that level. We're a rounding error out of the previous highs. We're right at the new closing highs, which is, again, super impressive. And the fact that we have round tripped from February to March and back to those same levels seemed completely insane back here in April, but we have achieved it. And the question now is, what's next? As I've talked about, I think a base case that makes sense to me is when you face a huge resistance level that so many people are anticipating. That anticipation of the resistance often provides all the resistance that you need, because enough people are expecting that pullback. They hold back on buying. They, will take some profits, assuming you'll get a little bit of weakness. That usually provides enough to push the market higher. I think a base case that makes sense is we pull back to around 3,200 to 3,250, which is in this blue shaded area. And I think from there, that's where we really have to question what's going to come next. And again, based on the long-term trends that I've seen and the long-term strength that you see in a lot of the charts, I would assume that most people will treat that as a fairly viable pullback, because all the other pullbacks in this uptrend have been the same. So I would not be surprised if we pull back and then come back up here, which will lead people probably to talk about the biggest cup and handle pattern that we've seen in a long time, which is returning to a previous resistance, having a shallower correction, and then we rotate higher. Having said that, it's all about the trends and where they're at. The trend undeniably is higher. The trend, for the most part, is very strong. Thinking about something like biotechs that have pulled back a little bit. So this is the candle chart we were looking at just a few minutes ago. If you look at a chart of biotechs, it's sort of in that traditional sort of viable point. And what I mean by that is a long-term uptrend, a strong trend where it's pulled back to a more reasonable level, a weaker short term, which means you're getting in at a better point. You're buying in at the short-term weakness within the long-term uptrend, and you're assuming that cyclical pattern will just continue up into the right. So a lot of charts are sort of at that point where if the market's going to resolve higher, we're sort of at that sweet spot where it might make sense to do so. Other stocks that have sort of rallied and broken to new highs, they're not, they haven't really pulled back yet. And I think it's what you might see if we get a pullback here in the S&P in the coming days, coming weeks. Having said that, charts like Tesla continue to move to the upside. The automobiles group is up over 2% today. This is Tesla's group, and even others in the group, GM, et cetera, have started to appreciate. I feel it's a sympathy vote with the strength in Tesla, but Tesla up again almost 3% today, continuing this relentless move to the upside. New closing high yesterday and another new closing high today. So again, until proven otherwise, these trends are certainly strong. I had some people asking about a bearish divergence, and again, we've seen that with a lot of charts in big technology and consumer names, where you have higher highs in price, lower peaks in RSI. What I would remind you is that this moment, this short-term uptrend is still in play, right? We're still making higher highs, which means you can't really call this a divergence until you get a pullback. When you get a pullback from the highs and you've established that as a now higher peak in the price, and then you can point to the lower peaks in momentum during that period, then you can talk about a bearish divergence. At this point, I don't think you can quite do it yet. As I mentioned earlier, this is sort of a traditional offense on the top with consumer discretionary, communication services, both making new closing highs. Technology, not quite a new closing high. Consumer staples making a new 52-week high again today, which I think is pretty noteworthy. When you think about the staples trade, this is something that's round tripped from the February to March low and now back up to those previous highs and continue to go higher. The relative strength has been relatively flat since June, because since the June peak, it's sort of kept pace with the rest of the market. But if you're not looking at staples, you're missing some charts that are probably stronger than you might expect in there. So maybe worth checking that out. On the downside, energy, and it's funny, when I mentioned some of the energy stocks yesterday, and I highlighted COG, which is Cabot Oil and Gas. I actually had someone write on Twitter, why didn't I mention some of these other names? They gave me a couple of stocks. All of those were in the mid cap and small cap space within energy. So when I'm looking at that S&P, I'm essentially looking at S&P members and large cap stocks to identify strength, and that's why COG is the top rated energy stock within large cap. If you look at mid cap and small cap, you certainly can find some names with some better setups within a sector like energy, financials as well. We're going to take a quick commercial break, but we're going to be back with my guest, Jesse Felder. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday for the Final Bar. As a reminder, 2 ways to get questions to us. Number one, via email, thefinalbar@StockCharts.com, or on Twitter, just tag us in a comment at FinalBarSCTV. A little later in this show, we're going to do a mailbag segment. We'd love to answer one of your questions later in the week. I want to welcome on my guest back to the show, Jesse Felder is the publisher of the Felder Report, a fellow Pacific Northwesterner. And Jesse, good to have you back.
Hey, Dave, thanks for having me back.
So as I mentioned in the introduction here, reviewing the market, I mean, so many people obviously are focused on the S&P retesting those previous highs. But, we're in this situation where it feels like a bull market in pretty much everything, right? You have bonds going higher, precious metals going higher. Maybe the dollar is one that's been a little divergent in his week. And you've sent a chart with us, which I think tells a really cool story looking at stocks versus other assets. Walk us through your perspective here.
Okay, well, I should probably preface this chart with another discussion about liquidity. A lot of people are pointing to Fed liquidity as driving all of these things you mentioned. It's driving the dollar lower, it's driving stock prices higher, gold prices higher. But I look at something that I call net liquidity as a concept that I got from Stan Druckenmiller, where he talks about what you need to look at is not the growth in the Fed balance sheet, but the growth in the Fed balance sheet less the growth in the total debt, net debt being issued. And with the Treasury issuing $2 trillion of new debt over the second half of the year, the Fed's going to have to buy that up if all of that for it to not be a pretty significant net liquidity negative for the markets, and something we haven't really seen at all over the past 10 years. This is sort of related, that because our bond yields have been so much higher than European yields and even Japanese yields over the past 10 years and getting higher, that's made our bond market more attractive than other developed bond markets around the planet. So it's attracted foreign investors to essentially do what the Fed has been doing, is buy treasuries, buy corporate bonds, and act as another liquidity input into our markets over the past 10 years. But what's changed recently, kind of similar to this other net liquidity measure, is that our interest rates have dropped dramatically relative to German and Japanese yields, which makes that demand for our securities in the United States potentially, drop off. And that's actually what we've seen. If you look at, foreign flows into our markets this year, it's dropped off pretty dramatically. So I would just suggest that both of these measures, are pointing to a pretty poor liquidity situation. And the way I think of it is, if we do get another sell-off in the market, there just won't be that potential support there that comes from the liquidity measures provided by foreign investors, like we've seen over the past 10 years, and potentially by the Fed. And the reason, I think the thing to pay close attention to from a macro standpoint is that if the Fed doesn't buy up this $2 trillion of new debt, that creates this net negative liquidity situation that I'm talking about. So I think it's important to pay attention to both of these dynamics. And by the way, this was a chart that I created using StockCharts data, and so it's real easy to put together.
Yeah. This is a really interesting take, Jesse. And I think that one of the challenges I think we're facing is that so many investors have just assumed the, unlimited buying support or the unlimited, crutch of the Fed. And that, on any pullback, we can assume that there's endless liquidity and endless ability to prop the market up. I mean, I'm curious, if we do get a pullback and that sort of safety net is no longer there, at what point, I would assume the market continues to go higher until people don't believe that that's possible anymore, right? When they start to, recognize that the Fed buying power is not what it had been, then people start to get nervous and start to go down. Is there a particular level, or is there a particular guidepost that you would look for that would acknowledge, all right, now investors are really getting nervous and the Fed's not going to be able to stop it, and it's a potential for a deeper correction? How would you see that sort of scenario playing out?
Yeah, I think it's not so much paying attention to the S&P 500 index itself or anything like that. But I said since the very beginning of this year, this is the year to watch the dollar, because it's going to be the dollar that determines how much the Fed is allowed to do. And actually, Robert Kaplan, Dallas Fed, had said this a couple of weeks ago, that there's a limit to the amount of money printing they can do, and the dollar is going to show them the limit. And I think that's why we're seeing, a much more difficult, Congress have a much more difficult time getting stimulus passed, is because, the Fed and the Treasury have been meeting, almost on a daily basis over the past month in regards to this. And I think probably those at the Fed are saying, we can't do another $2-3 trillion without the dollar really tanking. And so I think watching the dollar is important. If the dollar continues to roll over, and I think it's probably poised for a little rally here, but if it continues to roll over, it's going to potentially tie the Fed's hands, where they're not able to do as much as they would otherwise like to in order to support markets.
That's such a great take. We only have about 30 seconds left, Jesse, but I'd love to know, given this situation and given all the characteristics that you talked about, give us an example, one area, whether it's a group, could be a particular ticker or whatever you think you're led to share, but where would you see an opportunity now? Because I think looking at a lot of charts, you see these beautiful uptrends. Stocks just continue to go higher in tech, communication services, consumer. But where would you be looking now if you had new money to put in the market? What would you be looking at?
Well, I think probably the most attractive space, as you mentioned, is the worst performer today is energy. I think over the long term, if the dollar is going to tank, I do think this is the beginning of a new major bear market in the dollar. And that will be bullish for energy prices. Energy is its smallest weighting, I think, in history in the S&P 500. It's so cheap and out of favor right now that for long-term investors, it probably represents a terrific opportunity.
It's so funny. And I think I think another point you just kind of hinted at, I know a lot of individual investors don't probably pay as much attention to sector weightings as I know, institutional investors did. And I know I certainly spent a lot more time thinking about weightings, but, something like that, if institutions have to get in, all of a sudden it becomes a much bigger piece of the pie if the buying pressure goes back into it. And energy, it used to be a huge piece of the puzzle percentage wise, and it's come off certainly over the last year. Jesse Felder, thank you so much for joining us. Really appreciate your take and framing this out with a way of looking at liquidity, maybe in a light that a lot of our viewers have not seen before. Jesse, thanks again for coming on.
Thanks, Dave. It's always a pleasure.
That's Jesse Felder. He's the founder of the Felder Report and publisher of that report. Definitely check him out on social media. Jesse does such a great job of sharing sharing charts and perspectives freely, which is how I came to know his work and have enjoyed getting to know him and his process recently. Let's get to our next segment, which is the final bar mailbag. As I've mentioned many times before, I love the interactive nature of the show, and as much as we can, navigate these markets together, I can help address some of the questions you're running into. That's certainly a positive thing for all of us, I would hope. Question number one. Let's see. I have questions with regards to the time frame you buy on versus the one that you sell on. I'm wondering whether you sell on a shorter time frame than you buy on. Do you keep the time frames the same? Or is it the reverse where you might buy in a shorter time frame than you sell on? When I'm looking at weekly and daily charts, I'm more inclined to buy on the weekly charts, but sell on a daily breakdown. I've summarized your question, but I think that's really, really well phrased. And I think you hit on what's a key takeaway, hopefully, which is I think a lot of people very incorrectly and oversimplistically think of their buy discipline and their sell discipline as being very closely related. So your buy signal is X, and then obviously your sell signal is the opposite of that, right? So I'm buying when the PPO gives a buy signal, I sell when the PPO gives a sell signal. And in general, that tends to be an oversimplification. I think if you think about how you're buying and how you're selling and looking at the conditions that would compel you to do those things, I think you give yourself a little more flexibility to develop a system that's going to be more in line with better money management capabilities. Having said that, I think you've hit on a key point, which is I like what you're saying about maybe using different time frames. And again, I can't say what's exactly right because what's right depends on you and your investment horizon and what questions you're trying to answer using these investment vehicles, right? And I think so that's my first takeaway is there's no blanket answer for that. Having said that, I think thinking of them differently is totally fair, and I think that's probably encouraged. I think what you're hitting on when you're seeing buying with a weekly chart and selling with a daily chart is because the weekly chart, in my guess, is that you're buying on broader accumulation. So the weekly trends are positive. You're buying stocks that are working. When the daily chart starts to look bad, that's exactly what I do when I think about when to set a limit or set a stop or make sure I'm minimizing losses, more of the capital preservation. The daily chart can be really helpful because I'm focusing on any particular price level or a particular indication. When the price hits X and I put a horizontal line on the daily chart, that's when I'm gonna get out of it. And regardless of what I think or what the story is or how I feel about it, I'm just going to get out. And so I think the daily charts are very good because you can see exactly where the price is relative to those key levels. So having said that, you asked about monthly, weekly, and daily. I can't give you a particular answer because that depends on you and your time frame. But I think looking at weekly for buys and dailies for sells could be totally fine. And I would think about those two processes differently. Your buy discipline and your sell discipline could have a lot of the same inputs, but make sure you're thinking particularly about what's going to help you manage things effectively on the sell side. And also remember, a lot of people oversimplify. Buy means 100% buy, sell means 100% sell. Remember, you can scale in and out of positions, and charts can give you a great way to do that. Question number two, thanks, blah, 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 you're welcome. It appears Apple put in a hanging man candle on Friday after being stalled this week. How do you interpret that? Let's bring up the chart here. So this is a chart of Apple. You're talking about this hanging man candle, and I'll quickly zoom in just so we can see that a little bit better. Let's see, 3 months. Here we go. So the hanging man candle on Friday is this one right here, which you're absolutely right. This is a long uptrend. You have a doji candle essentially here where you have the open and close right at the same level and then a long lower body. So that is a hanging man candle, which is when the open and close are near each other toward the top of the range and then a long lower shadow. But the fact that the open and close are almost identical, which would make me call that a dragonfly doji. And again, you need to know that if you're studying for like the CMT exam, you need to know names of patterns, but overall the interpretation is the same. It tends to be short-term bearish because there is indecision, right? Anytime the open and close are right about the same level, the general thesis is short-term reversal. It's a reversal pattern because you've had this period of accumulation and then intraday you have a flat sort of indecision pattern. So that actually is short-term bearish, that particular candle. Having said that, remember candles like that on a long-term trend are telling about the next couple bars and that's it. And overall, it's more about the trajectory of the trend, which on Apple certainly has been positive. Next question, on your chart of the AD line, you have these horizontal lines indicating a level around 16,000. There's not one on the S&P. I think what you're referring to is this S&P breadth by cap tiers. Yeah, so, okay, you're asking about this horizontal line. So on this is the chart from the Mindful Investor Live chart list. I have the closing prices, then I have breadth on the New York Stock Exchange, large cap, mid cap, small caps, and I have these horizontal lines. These are my very simple indications. Anytime I put horizontal lines on there, for the most part, it's just trying to remember a particular price level. And so at this point, when these breadth indicators all broke to new swing highs, I remember keying in on these lows, and that's what I was focusing on there, and just looking to see if they remained above them, which they all did. I could probably update those, and I don't need them on there anymore. And that's a reminder. Tom McClellan usually pings me and very annoyingly but appropriately points out that I need to label all of these lines so I don't just have rogue lines that give you the wrong impression. So sorry for that. Tom's right on that one, and I need to do a better job of that. But that's all it is. I was identifying key levels on my charts, the ones that I use in my own investing. I have a ton of lines, trend lines, horizontal lines. I try to clean them up for putting them on the air because I don't want to confuse, but that's kind of what I'm doing. Final question, and then we have to wrap up here. I use the SCTR, the scooter rankings, as an important part of my analysis. That's great. Is it possible to scan for a range of scooter values or a particular value, which it is, but can I screen on the average true range of the scooter line? Because I find scooter rankings with a lower average true range are helpful. I looked at this ahead of time, just summarize it, but I'm showing you what it is. So the scooter ranking here is in blue. This is the biotech ETF I'm looking at. And in blue, it's showing you the scooter ranking over time, which can be really helpful. Some of the guys like Greg Schnell or Tom Bowley often have this as one of their indicators. I usually don't. I look at the current value. I don't pay as much attention historically, but they certainly have pointed out the value of that. You had mentioned the average true range of that reading. An average true range, just so you know, is basically looking at the range, the daily range, but adjusted for gaps. And that's why it's called an average true range. But to be honest with you, something like a scooter ranking, which is just a daily snapshot, you really don't need average true range. But looking at volatility, what I would do is look at the standard deviation. So here I've added a 10-day standard deviation right on the scooter line. And what you are suggesting is absolutely right. In general, strong scooter rankings with low standard deviation means it's high ranking and it doesn't fluctuate a lot. That tends to be a really good long-term chart, and I would 100% agree with you. So in general, when you see that pattern, that's probably a pretty good sign. Can we screen on that? No, we can't, but I've already sent that over to our developers to put on the development list for the next iteration of the scanning engine. That's our mailbag segment. Those are fantastic questions. We had many more. Some more we didn't get to, and we'll make sure we include them in the list for later this week. We need to wrap the show and go right to the 3 and 3 charts in 3 minutes. Here we go. Where did I put it? Here we go. Hold on. 3 and 3. Go. Chart number 1 is the DBC, the commodity index. I just want to point out, we talk a lot about gold and silver, especially in the last couple of weeks with the extreme rally, the exponential rise, the pullback last week, and then the recovery back to the upside. I just wanted to point out that a lot of the commodity index also looking very good. And commodity indexes can be a little weird because you're rolling commodities, you're doing a lot of different things, but the DBC is one that I refer to pretty regularly. This is a broad commodity index. It does have a weight in oil and energy. So if oil's not doing as well, it won't look as good as something like gold. But as a broad proxy for commodities, it's as good as any, I would argue. And it's interesting to note that the DBC has reclaimed its 200-day moving average for the first time since January, the very beginning of the year. It broke down there in mid-January, remained below its 200-day until just now. And while it's doing that, the RSI is just sort of remaining in this pretty bullish range. So overall, setting up as a pretty solid uptrend, recognizing strength not just in gold and silver, but across the commodity complex. Chart number 2 is EM, emerging markets. Jesse Felder, my guest, was talking about the weakness in the dollar, potentially short-term strength, but we've talked about the weaker dollar thesis and how that relates to some of the other macro themes that we've been looking at. I think it's interesting to see the chart of EM has broken above previous resistance and is just in this nice steady uptrend. I think what caught my eye was just the RSI remains in a pretty interesting bullish range. It's underperformed, and that's because of the weakness in the dollar overall, but strong commodities tend to mean strong EM. One other place where we've seen continued strength is in semiconductors. This is the SMH. Look at the consistent uptrend breaking to new highs. Look at the RSI that has remained above 50 since early April continues to be in a nice solid uptrend. Folks, that's our show. A special thank you to Jesse Felder from the Felder Report for joining us today from Oregon. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.